Everyone is talking about the coronavirus. How serious is a health and economic crisis it has created? Is there a way not only to retain savings, but also to gain wealth? This podcast provides an update on the virus problem and the global economic outlook, so that traders could orient themselves in this changing environment and make profit. Worldwide, there are more than 220,000 confirmed coronavirus infections. Among these, almost 6,000 are fatal. Out of each number, the biggest portion comes from China. However, that's not important now, not anymore. What is important is that a month ago, the coronavirus was almost exclusively a Chinese problem, and global powers were treating it accordingly. Bloomberg's virus map that had China in the center reflects this point well. That means the virus may spread much easier, hence the damage, humane and economic, may be significantly more severe. During one of the late-night meetings this past week with senior economic officials, the parties discussed the cost of the coronavirus pandemic to Israel's economy and estimated 30 billion to 100 billion shekels, which is $26 billion. These numbers were based on the assumption that the worst of the crisis will happen in April and May, and that as summer approaches, things will start improving. While China is slowly getting back up speed, other major countries are just starting to feel the bite of coronavirus. Overnight, the United States ramped up its response to the pandemic, with the United States Federal Reserve cutting interest rates to near zero, as well as announcing that it would embark on a new round of quantitative easing. Global markets shrugged off the cut, suggesting that more creative policy measures may be required to arrest the prospect of a recession. The forthcoming lockdown in large parts of the world will also hamper China's recovery effort. A supply side hit to the global economy is predicted from China's shutdown, but with the West now dealing with severe outbreaks of their own, demanding is set to provide an economic shock too. Some firms in China are concerned already that multinational companies may reduce their reliance on Chinese-made products, accelerating a shift to alternate manufacturing bases and damaging the extensive supply chain that has been constructed in the mainland over recent decades. Investors have been dumping equities amid worries the coronavirus will slow economic growth and take a bit out of corporate profits. Economists as JP Morgan see negative growth for the first quarter, while Goldman Sachs downgraded its first quarter growth forecast to flat from 0.7%. The rapid spread of COVID-19 across the globe has dramatically heightened investor uncertainty and record global financial markets, strategists at MRB Partners said in a note, adding the situation will get worse before it gets better. Looking ahead, the numbers of active cases is likely to worsen in the near run, they said. The stock market briefly rebounded after the Federal Reserve slashed interest rates from 1.5 to 1%, but Fed Chairman Powell expressed a desire to keep the short-term United States rate target about zero. Now, the entire United States yield curve is below 1% for the first time in history, a signal that investors are already planning for a worsening United States economic outlook. it remains uncertain if the Fed has enough additional tools to prevent an economic crisis alone. More importantly, the United States' continuous failure to support our most vulnerable workers has been laid bare. Without strong labor protections, universal health care, and sufficient paid leave for everyone, many working people face a precarious choice: take care of themselves or lose out on wages and even their jobs. According to Ellis Gould at the Economic Policy Institute articulates, only 30% of the lowest paid workers have access to paid sick days. Much of their corporate debt was used to buy back stock. When the stock market is in its boom bubble phase, that tactic pumps up the price of the stock and enriches executives. But when the market crashes, the corporation is suddenly saddled with a lot more debt relative to a lot less equity. Weaker corporate balance sheets impair their ability to invest in real economy activity. Meanwhile, the financial sector profited by enabling all of this corporate debt, which it turned into bonds. But someone bought those bonds, and as the risk of default grows, the bonds lose value. So investors are out of real money. They are also downgraded by credit rating agencies. Some of those investors, such as pension funds, firms that hold your retirement account, and life insurance companies, have fiduciary responsibilities. So they are forced to sell into a collapsing bond market, pushing bond prices down even further, as there is a scramble to convert assets with dwindling value into cash. The bond market and the stock market collapse in tandem, something that isn't supposed to happen. The uncertainty of such situations has made it difficult for experts to predict the damage to the economy. Some are offering probabilities that the American and global economies will slip into recession. Moody's Analytics said this week that the odds of that happening had risen to 4 in 10. Capital Economics pegged it much lower at 1 in 10. On Friday, Morgan Stanley researchers outlined 3 possible situations in a note to clients. In the most benign, the American economy does not slow at all in 2020 from previous forecasts, as the virus remains largely confined to China and Chinese factory production ramps back up in the coming months. In the most severe scenario, where the virus spreads more widely across countries and sectors of the economy, growth slows to a near halt in the United States for several quarters this year, leaving 2020 with 0.5% growth rate overall. The risks are clearly skewed to the downside until the outbreak is contained, researchers at Goldman Sachs said in a note this week. If the infection gains a bit foothold in the United States, it could disrupt the economy, which has been expanding steadily with an unemployment rate that has hovered near a 50-year low for more than a year. In an extreme scenario where the virus severely hits the United States, it could keep workers at home and grain production to a halt, hurting revenue streams and tanking even highly leveraged corporations as they fall behind on debt payments. In the least severe case, the current slowdown in China could cause a short-lived growth blip. Europe facing recession it was almost certain to go into recession over the coming months, and the German economy is particularly fragile, but the Italian economy and other parts of the European periphery are also facing very serious stresses right now as a consequence of trends over the last few days. Describing many parts of the Latin American region as similarly vulnerable, he added that Argentina in particular will be struggling as a consequence of the knock-on effects of this crisis. Commodity-rich countries face hit from stronger dollar. So-called least developed countries, whose economies are driven by the sale of raw materials, will not be spared either. Heavily in-debt developing countries, particularly commodity exporters, face a particular threat thanks to weaker export returns linked to a stronger United States dollar. Mr. Wright maintained the likelihood of a stronger dollar as investors seek safe havens for their money, and the almost certain rise in commodity prices as the global economy slows down means that commodity exporters are particularly vulnerable. Ultimately, Mr. Wright added, a series of dedicated policy responses and institutional reforms are needed to prevent a localized health scare in a food market in central China from turning into a global economic meltdown. Fitch said it expects China's GDP growth to drop to 3.7% in 2020 from 6.1% in 2019. However, in a gloomier scenario, Fitch said that global GDP could fall, with Europe down by more than 1.5%, the United States dropping 1%, and Chinese growth sliding to just over 2%. The high risk of escalating lockdown responses across the major economies means that the chances of a weaker outcome are very substantial, Fitch said. Looking further out, Fitch said that the emergency policy measures designed to limit the effects of the crisis should set the stage for a robust rebound, assuming that the health crisis eases. Rapid and large-scale macro-policy responses are all about damage limitation in the near term, but policy easing should help GDP normalize and recover quickly in the second half of the year on the assumption that health crisis subsides, Colton said. However, the uncertainties here are huge, and we are really only at the beginning of the process of trying to understand the full impact of the crisis on the world economy, Colton added. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.